So you can, if you mess it up and you don't amend it, you could be capping yourself on the properties you get conventionally for the next 2 years. Like, that's not even being dramatic. That is actual knowledge that you have to wait 2 years to have a Schedule C self-employed income. So you're capping yourself for that income for 2 years while also having that mortgage payment count against your debt. So that's just like, I'm going to stand on that hill until I die so people know this and people will file it correctly. Because it really sucks, because people have these big plans, right? They want 5 more properties in the next 3 years. Well, that's not going to happen.
Welcome back, everyone, to the podcast today. Very special guest, Brenna Carls from The Mortgage Shop. Brenna has been a great friend of mine, good business partner to work with. If you guys are looking for real estate investment loans for short-term rentals, you guys also do some primaries or just mostly investment properties now?
We do primaries. I mean, those are the easy ones. We can do VA loans. It's just 98% of our business is investment or vacation home loans.
Yeah, and I know you were just speaking at my tax strategy boot camp that I had early in October, and there was a lot of good takeaways from that in terms of like the mistakes that a lot of people are making because they're filing their tax returns wrong, right? Mm-hmm. Can you talk about, I guess, just some of those mistakes that you were referencing at the boot camp?
Yeah, so it's Schedule E as in Echo versus Schedule C as in Charlie, right? And one of the boot camp things that I was talking at earlier as well this year, I kind of said you want to follow your rental income on Schedule E investment, if you can remember that way, because you can add so many things back in as well as deduct your mortgage payment from that net rental income. On Schedule C as in Charlie, you cannot deduct that mortgage payment. So the mortgage payment is going to be counted against you. You can't offset it by the rental income that you report on Schedule C. You can use the income that you show on Schedule C, but it's not going to be as much. And without having to try to explain it without showing you a visualization, what I did on your session was show them the difference between the number showing up on a Schedule C versus what it would have been on a Schedule E. And it took the borrower's debt-to-income ratio from like 54% since they filed on Schedule C to, if they reverted it to Schedule E, then it would have been at 48%, and they would have then qualified for another conventional loan at that point. So it is very detrimental to your 1 to 3 year goals. And so that's why I talk to my clients and say, hey, what's your 1 year goal? Okay, what's your 3 year goal? Let's make sure they're matching up, and then make sure they're working with somebody like you that will file correctly for their rental income. Because many CPAs will make that mistake of filing it on a Schedule C because they think that you are offering personal services, such as an actual bed and breakfast with a kitchen and a cook in there and all of this stuff. And I just think it's just not widely known yet. That's how you're supposed to file it. And so, like, as much as we can preach to it, to tell people, if your CPA tries to do it on a Schedule C, do not allow them to do it on a Schedule E, and then can stop there, to digest that, and then I'll go into what you can add back on each.
So also too, isn't it true that if they put it on Schedule C that they need 2 years of the income as well?
Yeah, that's a good point. So Schedule C is known as a sole proprietor business tax return, essentially, and it's just filed on your personal tax return, right? As you know. When it's on a Schedule C, that's considered self-employed business. So if you're a realtor listening, most of your income is going to go on a Schedule C from what I've seen. And you need 2 years of self-employment history, like you would 2 years, employment history for any other job. So once it becomes self-employed, you do cap yourself for that entire year until you can file the next year's tax return to even use any of that income. Versus Schedule E, when it's on a Schedule E, you are allowed to use it after you file that tax return. There are guidelines, that will allow you to only offset your mortgage payment by it if you're a first-time investor. If you're an experienced investor, you can use the full net rental income on your application. I'm not going to bore you guys with that, but just know that you can use the rental income that's filed on your Schedule E automatically, as opposed to waiting 2 years.
Yeah, and also, so not only is it a disadvantage to file on C as in Charlie because you won't qualify as much for your debt to income,
Right.
You also need to file it for 2 years. And also, don't they if you're dealing with a Schedule C borrower, aren't they taking an average of the 2 years also?
Yeah. So if the first year is lower, they're going to do most conservative, right? So let's say you did 2022, 2023. If 2022 is lower, they're going to average those 2 years because it's the most conservative. Let's say you had a decrease in rental income in 2023. If that's the lowest, they're not going to average anymore. They're going to take that 2023 year, even though you have 2 years, and use that. So it's very much the most conservative approach for self-employed income. Schedule E, that's not a factor because it is rental income and not known as self-employed income. I do want to bring up also the cost segregation study for expediting your depreciation or putting it all, in one lump sum as opposed to over the years. I don't know this personally, but Schedule C, you can't really do that, right? You have to do it on a Schedule E.
I wouldn't say you couldn't do it. We've never done it actually on Schedule C.
Right.
Yeah.
And it's I think we've talked about it before where there's not as much tax benefit or something to that area of expertise that I'm not involved in, that it's not as much benefit as filing it on the Schedule C, because again, you can only add back so many things in on the Schedule C towards your income, like mileage. You can add back in if you have a home office, that square footage of whatever income they give towards that. Your gross income, amortization, casualty loss, and that's about it. And with Schedule E, if you guys are listening and think of this acronym, think of these words: take interest in depreciation. So that stands for taxes, insurance, mortgage interest, depreciation. You can add in other things like, again, amortization, but most of the time you're going to be seeing the big hitters are going to be adding your taxes that you've paid back in, adding your insurance that you've paid back in, adding your mortgage interest, which is a large number as well, because most of your mortgage payment, if you look at it, is going towards interest.
Especially those first few years.
Yeah. It's sad. Just don't look at it if you don't want to be depressed. But then depreciation is the big one, right? And then you add all that back in. Now, the difference is many lenders, well, I wouldn't say lenders, I would say many banks and inexperienced lenders don't do that, because I actually, right before I got on the Zoom, my executive vice president was like, hey, this lender is only giving us this for income. And they were only adding taxes, insurance, depreciation. They weren't even giving the actual rental income the property produced. And so I had to go and send them what the actual guidelines were in our calculator that we created for everyone. And so these top lenders, not even just run-of-the-mill somebody lending us money. It's the top 3 lenders in the nation that have most everybody's loans. We're showing them how to do rental income. So it's not, widely known. And if these top wholesale lenders in the country that hold most of these people's loans don't know how to do it, and most of your brokers and your bankers aren't going to know how to do it either. So that's why I tried to explain it as best as I can in layman's terms, but then also have that rental calculator for everyone to use. They don't even have to know how to use it. They just enter in the numbers it asks for, and it will spit out what your rental income actually should be.
So I'll say one more thing, and then I'll make this sort of correlation. The other problem with having it on Schedule C is that it's subjecting the rental income, which shouldn't have to pay any Social Security or Medicare taxes on it like you do at your W-2, to actually having to pay that. And we just reviewed a return. Client had it was $70,000 of net income on one property, and then $50,000 to $60,000 on another. So $120,000 of rental income multiplied by 15%. They paid an extra $18,000-ish in taxes just because they had their properties on C, Schedule C as in Charlie, instead of Schedule E as in Echo. We're actually going to be amending that client's returns, and we're going to charge them $3,000 to amend their returns, but they're going to save $17,000 because just in 1 year, they've been doing this ever since they've owned their properties.
They'll also be saving themselves if they try to go get another conventional loan, because at that point, we'll be able to add all of that back in and offset the mortgage payment plus add whatever that net rental income is to their personal income. And until you see the calculation up front, like, oh, it's not that big of a difference. It really is, because the 54% debt to income ratio, you can only go up to 50%, if Fannie Mae will allow you to, or Freddie Mac will allow you to, versus when we do it with Schedule E, that person was then down to 48% and qualified for that investment property. So you can, if you mess it up and you don't amend it, you could be capping yourself on the properties you get conventionally for the next 2 years. Like, that's not even being dramatic. That is actual knowledge that you have to wait 2 years to have a Schedule C self-employed income. So you're capping yourself for that income for 2 years while also having that mortgage payment count against your debt per month. So that's just like, I'm going to stand on that hill until I die so people know this and people will file it correctly, because it really sucks, because people have these big plans, right? They want 5 more properties in the next 3 years. Well, that's not going to happen. And they're going to have to wait 2 more years to even get started on their second one, which is crazy.
Well, I think you brought this up at the boot camp, but people actually don't realize it's a problem until
it's a problem
2 weeks, 3 weeks before closing, right?
Yeah.
I mean,
they'll know before that with us. But yes, most banks are like, hey, yeah, it's on Schedule C, and so the underwriter said we need 2 years. You don't qualify. And we see that so many times. So up front, when I'm like, here's your pre-qualification letter, that means that's gold. That's like a golden ticket for us, because we actually manually do all of that up front, because we're not trying to waste our time. We don't get paid unless the loan closes, right? So we're not trying to waste our time. We're not trying to waste, if it's a 1031 exchange, we're not trying to waste everybody's time on that.
Yeah.
Because time is money, literally. So the correct way is actually looking at it up front to make sure they actually qualify, which again, most lenders don't do in the beginning. And so it's just doing your due diligence up front.
Yeah. So what I learned is that, at least on the accounting side, when Airbnbs first became a thing, let's say, there was a lot of bad continuing education for accountants. So they would have these seminars and trainings and online or in-person events, and it was at these trainings that they were telling everybody to put Airbnbs on Schedule C. So that's why I believe there's this sort of like miscommunication about where they should be, and it's really hurting people, because they're overpaying in taxes tremendously, and they're screwing themselves from a borrowing power. But it also sounds like on your end, you guys are dealing with the same thing. There's tons of lenders that don't know how everything should be calculated, and they don't know that most Airbnbs should be on E rather than C, right? Do I have it right?
Yeah, and it's funny. I mean, it's a good thing for us, right? It's a good thing for you for business, because you know what you're doing. It's a good thing for us for business, because we know what we're doing. But we have to take continuing education, hours and hours of it every year as well in the mortgage industry. I just took one 2 days ago that was talking about the DSCR investment only loans. I know that like the back of my hand, and they had like rules in there where they said that your primary residence has to be worth more than the property you're purchasing to get a DSCR loan. I'm like, what? Like, there's so much misconceptions out there about investment properties with real estate attorneys, with CPAs, with mortgage brokers or lenders. So it does set us apart for this specific niche, because we know better than these huge corporations in the United States. And we're the ones that are actually teaching them. And at some point, maybe in like 5 years, maybe me and you will have more competition when it comes to that. But it's because we're the ones that are continuously educating people is why we would have more competition, which is fine. Because we're the ones that set the precedents. But yeah, like, it's just uncommon, and people don't know what they're doing in it. And even though we've been doing it for the last 5, 6, I mean, I've been doing it before Airbnbs became cool for like 9 years now, but it's relatively new to the industry as a whole.
Yeah. And people ask me, like, how do I come up with content or podcasts or post ideas? And it's literally just stuff that I see on a day-to-day basis. I mean, we onboard, I don't know, 30 new clients a month or so. I would say 2 out of 3 of them, which is 10% at least, we see a rental on Schedule C, bare minimum. Probably sometimes more than that. I mean, outside of that, there's tons of other stuff that we see that are errors in terms of like missed deductions that, hey, they pay property taxes. I know you have property taxes on the property. They don't just go away. Like, but you're you filed with H&R Block a TurboTax and you missed the property tax deduction, which hurt you because like that's cash that left your bank account, and you would have been able to add that deduction back anyway for lending.
And also the cash in your bank account, you could save and invest it somewhere else. Like it might not be enough to move the needle for a down payment on a property, but you could still put it in some type of account that's making you money as opposed to paying it to the IRS. I wanted to mention really quick for these self-employed people out there, I don't want you to freak out if your properties, if you have a partnership, for example, if you file a 1065 partnership return and your properties are on that, that's totally fine because usually it's on the form 8825, which is rental. It's basically a Schedule E for a partnership return, if I'm explaining it in layman's terms. And we calculated it just the same on the 8825. So we actually don't need 2 years either if you filed that specific property on your self-employed business return under the 8825. Now, if we're using all of it, let's say you made a K1 and you're paying yourself, like we do need 2 years of that for self-employed income. But if it's just the rental property that we're trying to get income from, we can just go to that form 8825, which is like a business form of the Schedule E, and do the same thing. So if you're self-employed and know that you have quite a few properties and you know that you filed it on a partnership return, more than likely it's going to be listed on that 8825, and we'll be able to add all that depreciation back in, as well as the mortgage interest, taxes, insurance, and things like that.
Yeah, and it's such a big deal. I mean, it's literally the difference between somebody closing on a property and not. I mean,
yeah, for two.
Or even further, right? And just I feel like we're like the only people that ever talk about it in the space. Nobody really, because it doesn't. It's always one of those. It's like when you see those things on the news or TV, and it's like, oh, that'll never happen to me ever, and then it happens to me.
It happens to you, yeah.
So many. I've had people that would listen to some of those older episodes where I had 2 really good episodes back in 2022 about tax strategy and your debt to income, or like financing and your tax strategy or whatever. And then I would have people that reached out a year and a half later, like, I listened to that, I understood that. I didn't think it happened to me, but it did. Right. And it's just like, so crazy.
I'll just tell my CPA to put it on Schedule E. Well, the CPA can hear you, but a lot of times they might not listen to you, and they're just going to be like, well, no, it has to go on Schedule C. And then what are you backed with? Like, are you going to keep continue? You're in that space now where you have to get your tax return filed. You can't switch over to you right now because you aren't taking on new clients during tax filing season. So you have to make sure your CPA knows what they're doing with that kind of stuff.
Also, in general, just the education on like reviewing financial statements for people, or like reviewing their tax returns. I mean, most people put, I have an email about this coming out at the end of this week, but like a lot of people put blind trust in their accountant.
Oh yeah.
I saw a guy in small business Twitter, this like thread that I follow. Their CPA like left off one of their LLC businesses, which lowered their income by a couple $100,000, which also led to him not paying taxes on that money. So good thing, bad thing for him. But no, he didn't find out until he went to go get a loan.
Oh.
So when he went to
listed, and then they just never filed it.
Yeah. So he must have had the income on the K1 last year, didn't have it on the return this year. The bank asked like, where, you said you made $500,000 or whatever, like where is the other income at? And then he finds out, 2 weeks after filing his tax return, that his CPA never reported the income.
Oh, that's right.
Is that crazy?
Yeah, that's not good.
So that's not good either. So
I've actually seen some where they just didn't have like a return that was filed, but it made no income. So I can get that. I can understand that. But if you've made hundreds of thousands of dollars, that's rough. Like, how do you even forget that? Maybe the CPA didn't forget, and he was just trying not to file it. I don't know.
Is there some kind of song and dance or strategy about, because we get this question all the time. It's like, do you put the loans in a spouse that makes more money than the other spouse, or is there like some kind of, debt shifting strategy? Like in tax strategy 365, like I have my own, I call it like equity stripping, shifting equity around your houses so you don't look as appetizing to like a lawyer or creditor. But is there anything on the debt side of that?
So yeah, I'm actually I bought like right next to me is like this huge freaking whiteboard that I bought because I'm going to start doing videos with it. But I talk about good debt versus bad debt. And good debt is the debt that you get to make more money, right? Bad debt is debt that's not making you any money, like your car, your credit card, student loans, anything like that that's not making you money. Anything, what's going to make you money is your mortgages, right? Your houses that you're renting out. So how I coach my clients is like, okay, if let's say the breadwinner wants to get a conventional loan, but they've got the auto loan in their name. Now their spouse, makes a good income, or they make, whatever income, and they're not the breadwinner. Well, freaking take that auto loan and just put it in your spouse's name, because it's not going to help you if you're the one that's going to be able to get more properties conventionally. Let's put that bad debt in the other spouse's name that's not making as much, right? So that's why I have to talk to you and be like, what's your 1-year goal? Well, what's your 3-year goal? And how are we going to match those up? So if you tell me, Ryan, you're like, I'm the breadwinner, my wife does make an income, but I'm the one that significantly makes more. I'm like, okay, if you're wanting the conventional loans, which have better terms, let's start with you. Let's see what debts, though, that are in your name or both of your names that we can just switch to hers and not worry about. The second part of that is a business bank account. And if you're using your car for your work, if you're a realtor and you're using a car for your work, here's like a free tip. Freaking create your business bank account. Start making that bank account pay your auto loan. And after 12 months of showing that business bank account paid it, we can exclude it from your debt.
Oh, yeah.
But, just exclude it altogether. So those are the strategies I work in. Now, the next strategy, let's say you're the breadwinner again, but we've gotten 7 properties under your name and your debt, no matter what, is just capped. Cool. Well, now you're starting to get equity in these properties, and that's when we get into that legal stuff of whether to put it in an LLC or not. However, there are true business loans, DSCR loans, that can close in LLC onlys. So what you can do is refinance into a DSCR loan into your LLC to take that debt out of your personal debt to open it up for you to get more conventional properties.
Even let's just, I didn't mean to cut you off, but let's say I don't know, 60% LTV on a property, 70% LTV. And I'm like, hey, look, well, my rate doesn't really go up that much if I have it in an LLC, or my monthly payment doesn't go up that much. Even just shifting it from your personal name to, okay, we're going to refinance it as a DSCR, keep the same sort of, almost the same amortization time or the same LTV. It takes it off your personal debt to income, which then opens up you for another, conventional loan, right?
Yep.
Wow.
That's exactly what it is. So there's so many strategies that we have to, that's why I do the goal setting calls at first. And I'm like, okay, here's where they're at. Here's where they want to be. Do we need to do some surgery and put these loans in an LLC only loan? Do we need to do some surgery and put these auto loans in their spouse's name only? A big one, Bill Faith, I did that. I had to do that with him at the beginning of the year. And he was like, what do you mean good, bad debt? Good debt, bad debt. And then that's when there's so many things that I say that I don't realize, like you said, that people don't know. And so it's just our job, right, to continue to educate and do this for people so they can be armed with the best financial strategy that they can get. Yeah,
I've had to learn that too, because after doing the podcast for 2 years, we have over 100 episodes now, and almost 1,000 posts on Instagram now, and I always have to remind myself, I might have the right message, but sometimes the person isn't in the right state of mind to hear it, or it may not apply to them at that point in time. But I just continue to do it over and over and over, because it seems like every day that I get somebody that's never heard of a cost segregation study before, or I get somebody that doesn't know the difference between C and E, right? But you said something in there about we had to figure out what your 1, 3, 5 year, 10-year goals look like, because it's one thing to just close the next deal, but how are you setting yourself up for the future? That's almost equally important.
Income do you want to make? Are you wanting to quit your W-2 job? Okay, what do you make? What are you bringing home per month? How many properties is that going to take to replace that income? we have to remember along the way the benefits of doing a cost segregation on this property, where you can get that back, where you're not paying as much to the IRS. Account for that. Have a business bank account where you keep that money in to pay bad debt. And like, if you do all of these things, it sounds like a lot, and it is. But if I keep telling people, just have tunnel vision on step one. And if that step one is either from you or for me, step one might be amending a tax return, right? From a Schedule C to a Schedule E, and that would be you. And then once they do that, step two is coming to me, and I say, okay, look, we can do this. If you want to set up where you're getting a lot of mortgages in your name to have that good debt, let's take this auto loan and get it over to your spouse's name. That's step two. And so if you just think of it step by step, instead of thinking, I've got 10 things to do to line myself up for success for the next 5 years, you won't get as overwhelmed.
I mean, that's a good point. Like because it almost seems a lot of times people, when I deal with a lot of people, they're either on one side of the spectrum or the other. They're like, they just dive in head first without really knowing what they're doing. And then they pay the repercussions later because, they either max out their debt to income, or they just pay a ton amount of money in taxes, and, they just don't know any better. Or they're like so analysis paralysis where they can't make a decision because of fear of like doing it wrong. And so, I'm not saying one is necessarily better than the other, but somewhere right in the middle of just, you have the right amount of like skepticism or, hoping that it works, but understanding that it may not. But also you have to have like the courage to move forward with whatever it is that you're doing.
Both options are going to lose you money, right? So if you hustle into it and do it wrong and miss steps, that's going to lose you money in the end. Like, you're going to pay more in taxes. Your debt to income is going to be maxed for the next 2 years. Then if you just don't make a move, you're literally not making any more money. So that money that's sitting in your savings account that's making 2 cents per year is not making you any money, which is just essentially meaning you're losing money that you could have been earning.
Yeah, it's like I did this podcast or this post series where it's like, the world doesn't reward overly safe people that never take any amount of risks, people that don't ever want to like step up in their job, but also at the same time, like, the world doesn't reward overly risky people either.
No, yeah, you have to make calculated decisions. And sometimes, I just made a post about my family and my husband's family looking at us like we're crazy, because I was like, I'm quitting my job at the bank and going to start my own mortgage company. And he was like, oh, I'm quitting my government job and becoming a helicopter pilot. They were like, what? And so, like, if we didn't make those calculated risks, it's a risk, right? It is always a risk, but you have to see, put down the pros and cons of it and what will outweigh each. And if you don't know, if you don't know, that's where you or me or whomever that person is in the industry that does have experience in that particular field can help them make a decision or help answer their questions along the way.
Was there anything else you wanted to point out?
I mean, I can send, I can put in, give you the website to the link to the...
Yeah, we would love that, actually. How do we get access to the income calculator, right?
Okay, it's just brennacarls.com/rental income calc.
I'll put that in the show notes. Where else can people find it on social media?
Yep, so Brenna Carls on Instagram. If you guys have been following Kenny Bedwell, we have a lifelong competition of who can get the most followers. If he loses, he has to sing karaoke live streamed, and his song of choice will probably be Like a Virgin, and it will be much more entertaining than me losing.
When is the deadline for this?
We just talked last night. He called me last night, and he was like, I think it's like a forever deadline. I was like, yeah, until I actually win, and then I'm calling it.
It should just be annual, like just have a running counter of how many followers you each get every year.
Yeah.
Yeah, so, and then do it at the STR Wealth Conference every year.
Yes. So yeah, Brenna Carls, Instagram, Facebook. We also have the Financing Short-Term Rentals Facebook group. Brian is an expert in there for CPA knowledge, and you can ask all of your financing questions in there as well. All you have to do is search Financing Short-Term Rentals. He'll publish the link as well. It looks like 90s Miami Vice looking, like my background right here. And that's our group as well.
Awesome. Thanks so much.